as regulators, we need to look and shift our eyes towards what's happening on the other side of the fence, so to speak, and say, what can we do to help credit unions compete and get that business away from them? Not what can we do to, provide a cap. And it doesn't always help a low-income person or a person that's using payday alternative loans. It doesn't always help them to just continue to push them over there, because now we have all these parameters set because we're limited in our rates. And so
hello and welcome everybody to the latest edition of the Credit Union Connection. We're going to be talking the 18% credit union APR cap that the NCUA just reestablished last week with the golden girls of CU strategic planning, the ladies.
Is that old, Sarah? Is that old?
Okay, maybe that wasn't the best. You're just golden. You're just gleaming. The ladies of lending, credit union strategic planning, Shirley, Senn, and Sharon Hall. So welcome, ladies. You introduce your company and yourselves.
Sure. Well, thank you, Sarah. We're glad to be with you today. As you said, we're with CU Strategic Planning, and we are really celebrating actually our 15th year this year anniversary. And with that, we've hit a lot of milestones over the last 15 years. CU Strategic Planning really provides a holistic approach for credit unions that are in the community development financial institution space, CDFI. And we work with credit unions from the very start through their sustainability through this process, working with them on getting them certified is the first process, working with them on applying for the various grants that come under the CDFI fund umbrella, which definitely has been quite a few lately here as a result of the last couple of years, and $12 billion worth of programs that have come through that. And then on the other end, making sure that our credit unions stay in compliance through annual certification reporting, as well as the grant reporting, and so many other facets of just really helping them on a hand-holding journey through this whole process. And in that, I serve as the Chief Social Impact Engineer and one of 6 partners with CU Strategic Planning. And my role primarily is in the research side and data analytics development to help support a lot of the various grant strategies and programs that we work through. And we're really proud that through the last 15 years, as of the last most recent round, we have helped our credit union CDFIs win $945 million worth of various grant programs that are getting leveraged in so many unique ways in their communities to help with poverty alleviation and empowering communities. So we're really proud of that because it's really a testament really to the credit unions themselves and their efforts and impacts on making a difference.
And Sharon, you want to quickly introduce yourself too?
Yeah, I am Sharon Hall, and I am one of those 6 owners that Shirley talked about. And I'm the CFO here, but I'm not your traditional CFO. Shirley will shake her head no, she's not traditional. I do have a business background, and so I run the internal financials for our organization. But externally, I was the CEO and executive director of an interesting credit union in Seattle called Express Credit Union. Give them a little bit of a nod. Mm-hmm. And interesting model that they had that we developed there, which was a credit union working directly with a nonprofit. So it was very interesting. So I got a lot of experience working there and came here. We actually have the nonprofit here. It's the National Council for Financial Opportunities. And we get to just broaden the impacts and help you can work in a community and you can really spin your wheels, and then with the actual shoot of, or shot of, I should say, of grant money can really propel a credit union to the next level when it comes to community impact. So we are super passionate here, and excited to be talking about this subject, Sarah.
Yeah. So I can attest to you all being super passionate about it. Tell me a little bit more about, I know you guys do a lot of really creative, or your credit union clients do a lot of creative programs to qualify for CDFI status. So, I mean, and we'll get, I mean, the primary topic today is going to be the interest rate cap, but talk a little bit about those programs, because I want to get later to how much that cap impacts what y'all are doing.
We do everything from the beginning, and there is no end, right? So it's unlimited what we can with a credit union. Shirley talks a lot about the pathway, basically, as a lot of CDFI credit unions understand the pathway to financial resiliency for a person of modest or low income means. We also believe in that pathway for financial institutions, and it comes from certifying them, and you certify them with their loans, how many loans that they're doing in the community. We provide services to help identify the target markets, which helps them become certified. And then when we walk them all the way through the path, from implementation to grant coordinations, and then on the we do compliance. We help all of them with all of their grant reporting. We have ESIP programs out. We have ERP, and we do lots of acronyms in our industry. So we have lots of programs for compliance purposes. Shirley, why don't you talk about what you're doing with the next step of that?
Yeah. So as Sharon said, really the start of this point is the certification and then the grants, but also, really for a credit union that is a CDFI to have sustainability, there's really got to be this mindset of it's really a culture shift in what they're doing. And then it's got to be embedded from everyone from the front staff, working with your direct member there at the teller desk, or whatever means are being used these days to get to our member, all the way up to the CEO and the board. And so, this is part of the process that we're working with credit unions now on. Really, it's a holistic approach in terms of really helping them and understanding how they can leverage their policies and their products, their marketing, their board culture, their staff culture, sales culture, everything that they're doing to really focus on how to alleviate barriers and challenges for communities that are experiencing distress, whether that's economic distress or health distress, education. So there's a lot of things that go into this that we have to think beyond the traditional means of what we do in credit unions. And sometimes this requires us to think a little differently, think a little more broadly and sustainable for what we're doing. And so, we're really excited about this next step that we're taking in helping credit unions really, as Sharon said, continue that journey, indefinitely, to ensure that, that they're meeting the needs of their communities and even further than that.
Yeah, no, I've talked to some of your clients before where, and one in particular stands out, where they were helping people recently incarcerated who were being released, yes, before they were released, improving their financial education and understanding, so that when they got out, they were able to, excuse me, truly get on the path toward rehabilitation, right? They, were given bus passes so they could get to the community center where they could find a job, and they were, there was a partnership there too. And so, what are some of your favorite programs, or some of the more unique programs that you think your credit unions are offering that are particularly helpful, whether it's lending or what have you?
I
Okay.
love them all. I think that I'm going to say, I'm going to use the term blessed. We are blessed to have the tools and the resources that we need to help create those strategies inside those communities. Um, I think that there's a few of them that really stand out to me. Um, there a credit union in Montana is doing a domestic violence um, strategy that works with the women in their county, really deal with the impacts of domestic violence and getting them out there. They partner with the shelters there, and it's such a rewarding experience to watch and see how sometimes we just think just an account or just a loan
Right.
really impacts a life. So that's one that stands out for me. Another, I particularly am very close-hearted to some of the native credit unions that we work with, and working with very small native credit union in South Dakota, and just seeing what is going on in that community and how just a car loan can change the life of a person who has probably taken on all of the responsibilities of nieces and nephews and grandchildren, and how that really changes their lives. So it seems like it's just a small thing, but it's on a big scale. It's very large for that end user and client.
Right. Yeah. Life changing for that individual borrower, but also for the credit union to be able to, one, I think it's a great employee morale booster, right?
For
That you're
sure,
doing
for
that
sure.
for.
And it
But
has such
the whole community
financial,
lifted up. Yeah.
yeah, community development work is um it financially impacts the credit union for the better. And that is counterintuitive to what a lot of credit unions think when they go into it. They're like, oh, my charge-offs are going to go up. All of this, these horrible things are going to happen to my financials and my ROA. And that's when I get all excited because I talk about, okay, and it has absolutely the opposite impact, because as you gain loyalty and you gain relationships, and the folks that were more likely and underbanked, um, they become successful in your credit union, and the more success they have, the more success you have.
Mm-hmm. How about you, Shirley? You have a favorite program?
I do. There's a couple. One of them had to deal with a community in Little Rock, just outside of Little Rock, called Pine Bluff. And when you look at this area, it's one of the most distressed in terms of statistics. At the time we were doing the grant, it was actually per capita had more crime and more persistent poverty than Memphis and Detroit. And the strategy that we worked with this credit union is, in this little town of 60,000 people, there were more than 800 blighted properties, and a lot of those were residential homes. And the issue obviously was that with such low income and wages in the area, a lot of people couldn't qualify to purchase a home, but yet there were vacant lots and things that could be rehabbed. So this particular credit union, we worked with the city. The city actually donated vacant lots that were already prepped for utilities. And so what the city did is they believed in a sweat equity type of situation. So they were willing to give the lots to the credit union to use in turn to give to a borrower if the borrower provided some sweat equity in the building of the home. These were also unusually shaped lots, so getting plans that were designed and approved by the city could take time. So they worked with some local contractors and architects to develop, I think it was 3 or 4 plans that would fit on these lots. And so the credit union provided the financing, provided the down payment assistance, and would work with the borrower to develop housing. So, in essence, it's a win for the credit union, it's a win for the borrower, and it's a win for the community. because, land obviously that was not producing any type of tax revenue. We've now got someone that was in Section 8 housing actually owning their own home and building wealth. And really the benefit of all this is there was such a long waiting list on the Section 8 housing there that it freed up, additional apartments for people that were on the waiting list to be able to move in and start that. So hopefully to start that life of building wealth as well, allowing the utilization of some of the tools. So it really, it was really an empowering opportunity for this credit union to work with its local faith-based institutions and the local municipality and the credit union itself really, coming up with solutions for that particular area. And then there's another one that really, I think, plays a little bit off of what, Sharon was saying in terms of her one in Montana is that, it doesn't matter what state it is in most cases, I think, except maybe Utah, where the gap, wage gap between men and women, is always in favor of men. And the development of a women's empowerment program that is really helping financial inclusion, helping these women start from the very base of getting membership and getting just a transaction account so that they can cash checks or use a debit card without the exorbitant fees of a check casher or a payday lender, and then helping them along the way, holding their hand with this very inclusive financial education and financial coaching to help them with their financial well-being, giving them, that first time auto loan, and maybe they don't have any credit score, they're credit invisible, and these credit unions are working with them, to develop that. So successful in some cases. There's credit union in Louisiana that's now on, I believe, just completed their second grant and winning with this exact strategy. They've been so successful that they have exceeded their goals within their time period and are continuing to find impacts in their communities. And that transition is necessary for really breaking that multi-generational poverty and working with both the single mother in some circumstances, beyond her control, and working side by side with the children to help them understand how not to repeat this.
Yeah, no, I love hearing your stories. I had goosebumps while y'all were talking. And so both of you talked a little bit about programs that offer lending and building wealth, because wise use of credit is often good for wealth building, right? And getting those families out of perpetual poverty and generational poverty. And so this last week, as I mentioned, the NCUA reconfirmed the 18% cap on credit union lending, which is flexible between 15 and 18 statutorily. It's been at 18 since as long as I can remember, regardless of what the prevailing market interest rates were. And that's been a couple decades now. Obviously, when you're lending to people with low credit scores, no credit scores, low income, sometimes how does that rate cap impact credit unions' ability to lend, especially in the current market?
This is where I start kind of getting, I have a very strong opinion, Sarah, so get ready.
Please go for it.
Yes. So the thing is that the wrong group, banks and credit unions, the wrong group is being regulated. What needs regulated out there is the predatory lending. Online predatory lending is out of control. Buy here, pay here lots where someone has no credit and they're charged 24 or 30. It's not capped. And instead they're capping the good guys, right? The depository financial institution. And it's that depository piece of it that's so critical to the success of any of us. Even me, I can't do business. I can't do my job. I can't even be personally successful without a bank account, right? And so I think that they want to continue to stay the good guy, so they keep the caps low, and they don't consider what the financial institution's up against. And we're not, credit unions don't fight credit unions. Credit unions go out there and fight the actual bad guys that are charging these enormous rates. And that's our actual competition. We need to keep our eye on that competition. So my number one pet peeve is, could you please go regulate them before you continue to regulate us? You know, before you continue to put a cap on us, to continue to drive our business down, go look at the reason why we're here. And the reason why we're credit unions are here from the grassroots is because nobody wanted to serve the low to moderate income people. So we started credit unions to do that. And we need to continue to be allowed to do that at the way our market will allow us to do it. So if the market in our area can bear something more than 18%, they need to allow us to do that. Not that I think that 18% is the do all end all, but they need to allow us to work in that market the way the market allows us to do it.
Shirley, your thoughts on that?
Yeah, I play right into what Sharon was saying, and I think if you look at a lot of the state chartered credit unions, I mean, I think that really is taken into consideration when you look at caps from California or Florida or Texas. You know, I think they take into consideration some of the unique circumstances that may be in those geographical regions. You know, when it comes to the setting of the rates as well, I mean, I think credit unions have gotten smarter. I mean, I think we have better tools today. We have more sophisticated analytics that we can really take a look at a much deeper picture of our borrower rather than just looking at a credit score. Mm-hmm. And so, you know, when credit unions are embracing risk-based lending, I think this gives them an opportunity to use what we like to call a lot of times, I think, character-based lending, and really taking a look and saying, okay, you know, this person may not have the traditional credit score, but they've been very responsible in paying their rent and paying their utilities and paying, you know, other forms of lending that are not necessarily traditionally reported to credit bureaus. So I know, you know, a lot of credit unions are considering that. And while yes, the rates, you know, need to be reflective of the opportunity to provide someone or a family and, you know, the option of getting a loan for a car so they have transportation, I think credit unions have been very responsible for the most part in staying within a range that works for them and their unique areas. You know, my husband was in the military, and, you know, there's always been concern about payday lending and predatory lenders around the military community and setting caps at 36% and so forth. But again, we've got to look at what our own geographic regions and our unique areas will bear in the market without looking predatory or being predatory. And, you know, Sharon made a really good point in that, you know, embracing the community development financial institution model. Yeah, I mean, if you look at a traditional credit union versus one that's CDFI, there are operational differences. But in most cases, if you look at a CDFI credit union's ratios and financials, you know, in the most part, they perform well. They manage their risk. You know, if we were to compare the traditional credit union peer group versus a CDFI peer group, for example, operating expenses, it's not going to be unlikely that CDFI credit union operating expense ratios are going to be higher because they work differently. There's a different level of how they work in the community and what communities they're working with. Should we just look at operating expenses to determine if a credit union is going to be successful or not? No, we need to look at the whole picture. So sometimes, as Sharon said, you know, we need to be looking at what are the bad guys doing? What are they coming up with? How are the different states and even federal regulations still allowing loopholes for this to continue to be a problem?
Yeah, I think, and And if we continue to have a cap, without looking at a broader picture of this and saying, you know, credit unions offer longer terms. If somebody's going to go out and get a payday loan, they're going to have to pay it off by the next payday. That's what payday loans are about. You pay it off. That's usually a 30-day term. Credit unions don't do that. Credit unions offer a longer term, so it's actually something that someone can pay off and not roll over. And so they're not actually, if you're paying it over time, you're paying for the risk of that. You're trying to compete with them, with that payday lender, where you just walk in the door and you show them that you have a paycheck and they give you a loan, and there's no other check behind that. When you start capping and forcing a credit union you're forcing them to not be able to compete at the level that payday lender is competing at. So now we have to put risks parameters around those loans, because our rates can't rise a little bit, or shift a little bit to look at the risks that some of those loans have. And so it's kind of like the no, it's not fair kind of issue. But I just do really think that we need to, as regulators, we need to look and shift our eyes towards what's happening on the other side of the fence, so to speak, and say, what can we do to help credit unions compete and get that business away from them? Not what can we do to, provide a cap. And it doesn't always help a low-income person or a person that's using payday alternative loans. It doesn't always help them to just continue to push them over there, because now we have all these parameters set because we're limited in our rates. And so we're just going to keep forcing them over there instead of bringing them to where they need to be. And that they'll forever be a home for them.
And just kind of playing off what Sharon's saying, when we look at the PALS programs, bringing them in and working with them, educating them, letting them use those higher rate than the traditional maxed 18%, but still 28% is so much better than APRs of 300, 400, 500, 600%, and then giving them the opportunity to work with them. So, there's a couple of things, even when we look at some of the predatory products that are out there, hardly any of them report to the credit bureau. So they're not building credit at all. Bringing them into the credit union system allows the opportunity for the credit union to report those on-time payments to the credit bureaus to help them develop a credit history that then will allow them to refinance, the higher interest debt into lower debt as they've, come into the mainstream financial institution opportunities that credit unions provide. So I think, really see the benefit of having some of that flexibility to move them away from things that time and time again and study after study really truly do show the harm that a lot of those predatory products are providing.
Yeah, and one of the things I've heard credit unions accused of before is, you're just cheaper banks, which is, both of you kind of touched on this a bit ago. It's not about that. It's about not allowing them to roll over the small dollar loan, but to extend the term of it to start with, so they don't get caught in that trap. It's about the financial education piece. It's about the creative programs that these credit unions come up with that actually solve a problem, not just the standard vanilla offerings. So I just said a lot. I don't know if you guys have any.
No, 100%. You said it just really well, succinctly. The best part about credit unions is that they work with their members, whether they're a CDFI or mainstream credit union. They work with their members and they want to see the success. I think every credit union should be a CDFI, by the way. Blasphemy. But they should, because that's their roots and that's what they do. They work with their members to have their members see success and feel success with their membership. they want to get credit. They want to get their members in home loans. You know, they want to get their members in the home is what they want. So that's their ultimate goal. And how they get there, their policies and procedures gives that lender more flexibility than happens at a bank. Because at a bank, what they're looking at primarily is how can we maximize our profits for our shareholders, and that's not what credit unions are doing. So it's how can we maximize the goal of the person that's sitting in front of me, and that's what's great about credit unions.
Yep. I think another thing that's good about credit unions is that, I mean, we understand in a business model that we can't always say yes. But I think what credit unions do is they build out that pathway again of, if they can't say yes right now, how can we say yes? How can we get you to a yes in 3 or 6 months? You know, and it really, that to me is also a differentiating factor of taking that personal time and working with that individual or that family to prepare them and make sure that they've got the tools and the education that they need, and you know, to give them the opportunity to reapply. And I know, you know, multiple credit unions that have successful, you know, they run departments inside their credit unions that, you know, when a loan may be denied initially, they'll send them immediately over to their department that works with them one-on-one through that whole process so that they can get them qualified for a loan. And, you know, another significant difference between credit unions and banks is just that extra time that they're willing to take to make sure that there is success for that long-term financial well-being.
Yeah.
All right. So as we wrap up, do you all have any final thoughts? Do you want to tell the NCUA, Sharon?
I know, right?
Any other
Yeah,
final
I have a
thoughts?
lot of opinion.
Yeah.
Yeah, I mean, if I was talking to the NCUA right now, I would really want them to consider who the true competitors are here, and who's actually hurting the community. And it's not the credit union, and it's not a cap of, you know, random interest cap that hasn't been moved for I don't know how many years of 18% or whatever those caps are. What they really need to do is give the credit unions and some community banks, you know, give them the opportunity to really serve that community and drive those predatory lenders out of the community. Doesn't have to be just payday loans. It's all of the predatory lenders out there. Get them out of the community. We don't want them in our communities.
Heck no. There's more of them than McDonald's, right?
Yeah, but really, if regulators stop to think about what's our end goal here, and if it's helping the community and helping the member, that's how to do it.
Mm-hmm. How about you, Shirley? Final thought?
Yeah, if I was going to say something to NCUA, I would applaud them. When I was at the CU Financial Health conference in Las Vegas, one of the things that the NCUA representative said there was how they're engaging with minority depository institutions and working to help examiners understand the difference and the uniqueness on how communities of color and their financial inclusion needs are different sometimes than just a traditional credit union. And so when they're looking at them from an examination standpoint, to understand the differences in the operations and the finances and so forth. And I would encourage NCUA to take that one step further and also include in that just community development, financial institution, credit unions in general. Because again, you know, there are differences in how a CDFI credit union will operate in a situation with unique communities than a traditional credit union may. We're all there to serve people. We all do a great job of the philosophy. But in some cases, sometimes it takes a unique role and that flexibility Sharon was talking about to ensure the sustainability. When you try to put everybody in the same box when we're all different, you know, sometimes it can be to the detriment of the impacts and the positive things that are being done for some of those non-traditional ways of doing business.
Yeah, no, and there was one of your clients I just spoke with like a week or two ago that is working with the city to eradicate debt for people who have received terminal diagnoses because they're in a cancer corridor.
Yep.
So it's just amazing the kind of work that credit unions are trying to do, and community development, financial institutions in general, but of course credit unions is who we like to hype. So yeah, just amazing stories of the credit union difference that's not just about being cheaper than a bank. I want to thank you guys very much for joining me today, Sharon and Shirley. Thank you.
Thank you,
Yeah,
Sarah.
thank you.